Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first Trump's Fed chair shortlist pits BlackRock's reader against insiders, signaling a potential overhaul of US monetary policy. So we'll discuss why this leadership battle could reshape the Fed's entire philosophy and what it means for future interest rate policy and market stability. Second, MP Materials stock plunges over 7% as markets price in a US. China truce premium, fading fears of a rare earth supply chokehold. We'll explore how this short-term market relief deepens long-term strategic dependency and tests the West's industrial policy for critical minerals. Third, $130 million private donation pays US military during a shutdown, sparking a firestorm over moral hazard and national security influence. We'll examine how this unprecedented act blurs the line between philanthropy and political influence and how it could impact future government negotiations. The race to control the Federal Reserve is officially on, and it's happening months ahead of schedule. Treasury Secretary Scott Bessent has confirmed the list of candidates to replace Fed Chair Jerome Powell has been cut to just 5 names. Donald Trump says he plans to name a replacement by the end of this year, even though Powell's term doesn't expire until May. So who's in the running? The shortlist pits Fed insiders against Wall Street power players. It includes current Fed governors Christopher Waller and Michelle Bowman, former Fed Governor Kevin Warsh, National Economic Council Director Kevin Hassett, and a major name from the private sector, BlackRock executive Rick Rieder. Each of these candidates represents a completely different future for the Fed. First, you have the insiders Waller and Bowman. On the surface, they represent continuity, but their voting records suggest they might be more aggressive easers than Powell. They recently dissented in favour of cutting rates sooner, which points to a shorter easing cycle before quickly pivoting back to watching the data. This would not be a seamless transition like we saw from Yellen to Powell. Then there's Kevin Warsh, former Fed governor who is now a known critic. His nomination could trigger a fundamental shake-up of the Fed's entire operating system. For the past decade, the Fed has used a floor system with abundant cash reserves. Warsh might want to return to an older corridor system. A change like that would create massive uncertainty. Markets would have to price in a reform premium, likely leading to higher long-term interest rates and more volatility for assets like bonds. Next, we have Kevin Hassett, a candidate seen as highly political, which brings the Fed's independence into question. If markets believe the Fed is no longer independent, they might stop believing in its ability to control inflation over the long term. This is called the de-anchoring of inflation expectations, and it could increase the risk premium on US government debt, threatening its global risk-free status and forcing a future Fed to become extremely aggressive just to regain credibility. A painful situation we've seen in countries like Turkey or Argentina. Finally, there's the wild card, Rick Rieder from BlackRock. He's a market practitioner, not an academic economist. A Fed led by Rieder would mark a huge shift from the academic-led Fed of the past 2 decades. It would likely be more reactive to real-time market data and less driven by economic models and long-term promises. This could make the Fed's famous dot plot less reliable and increase market volatility, as traders would have to react to data as it comes, not to the Fed's guidance. But that's not the whole picture. The real turning point is that this is about more than just the top job. The stakes are a potential takeover of the Fed's board. Should Powell choose to leave the Fed entirely after being replaced, that would give Trump a 4th appointee on the 7-member board of governors. That's a majority. A board majority can control the direction of monetary policy for years, influencing everything from the interest rates on your loans to the overall money supply in the economy. This all comes as one of Trump's current appointees on the board is already campaigning for the Fed to be more aggressive in its policy easing. What really brought this to a head was the contrast with the market's short-term focus. While this long-term battle for control of monetary policy heats up, the market is pricing in a near certainty that the Fed will cut interest rates this week. The market's expectation for a rate cut is based on current economic data. A short-term reaction. The leadership turmoil, however, creates deep uncertainty about the Fed's long-term strategy. The market can easily price in the present, but the future has suddenly become a huge question mark. So, looking ahead, the immediate concern for a global audience, especially in China, is how this might spill over into currency markets. A new, more politically aligned Fed chair could face pressure to use monetary policy to counter China's currency influence. This could risk igniting a new front in the trade conflict, a currency war, which could disrupt global supply chains and put central banks in Europe and Asia in a very difficult position. For investors, this means we need to prepare for potentially high volatility in stocks and keep an eye on long-term bond yields. They could rise if a reformer like Warsh is nominated. The key indicator to watch will be the 10-year break-even inflation rate. If that number starts to climb, it's a market signal that confidence in the Fed's independence is starting to erode. This is a story that is just beginning to unfold. Speaking of US, China economic tensions, another front in that conflict saw a dramatic shift yesterday, this time in the critical market for rare earth minerals. Yesterday, the US stock market was buzzing, not about tech giants or banks, but about rare earth miners. A while back, we broke down how this space became the front line of what we called symmetrical trade, weaponization, rare earths as the chokehold in a tariff standoff. Just as a refresher, rare earth elements are a group of 17 minerals that are the secret ingredient in almost all modern technology. We're talking about things like the super strong lightweight magnets in electric vehicle motors and wind turbines. Without a stable supply of elements like neodymium and dysprosium, building a green energy future becomes incredibly difficult and expensive. Specifically, MP Materials, the largest rare earth producer in the Western Hemisphere, saw its stock plummet, dropping a staggering 7.37%. At the same time, the VanEck Rare Earth ETF fell over 5%. So the thing is, the market is pricing in what experts are calling a truce premium. This means investors are betting that the threat of a supply cutoff is fading, which would lead to lower rare earth prices in the short term. Lower prices are bad for miners' profits, so their stocks go down. The market is betting on a potential deal between President Trump and President Xi. The rumor is that China might delay its threatened export controls on rare earth minerals, perhaps in exchange for a delay on the US side for those 100% tariffs. Remember, those controls have operated as a strict licensing regime, not an outright ban, giving Beijing a dimmer switch on exports. However, if you zoom out, you'll see another layer of strategy at play. China may be demonstrating that the threat of export controls is a more powerful geopolitical tool than actually using them. By creating uncertainty, they can pressure counterparts for concessions without actually disrupting global supply chains. We've seen this play before. Exports dipped by about 5% for 2 months, then spiked more than 60% in June. It's proof that Beijing can dial friction up or down without cutting supply completely. This is high-stakes poker, and the chips are critical minerals. The situation presents a fascinating duality. A delay in export controls is a temporary lifeline for downstream industries like EV and wind turbine makers, potentially accelerating the West's green energy transition. But this short-term gain deepens a long-term strategic dependency, as China currently manufactures about 90% of the world's rare earth magnets. This truce premium also creates a major test for the West's industrial policy. The US has been using incentives to encourage billions in private investment for friend-shoring. But the sharp stock drop for a company like MP Materials shows that this private capital is highly sensitive to geopolitical winds. It raises a serious question about the long-term viability of these policies if they can't sustain investment through periods of diplomatic calm. And as we flagged under the so-called Becent doctrine, policymakers may prioritize China policy over short-term market calm. Ultimately, we need to distinguish between short-term market noise and long-term structural trends. The market's sharp reaction to these talks is a leading indicator of sentiment, but it might be masking the bigger picture. The underlying trend of US-China economic decoupling is supported by a strong, entrenched bipartisan consensus in Washington. That is a structural force that won't be reversed by a single deal. Looking ahead, we can expect continued volatility in these specific stocks. The most important focal points to watch are not the rumors, but the official policy announcements from China's Ministry of Commerce and the US Department of Commerce. If the Trump-Xi meeting fails to lock in a pause on controls, the tail risk we flag moves toward baseline. If a pause holds, decoupling doesn't disappear, it just gets masked by calmer headlines. These will be the true signposts of where this strategic competition is headed. While Washington might seem united on long-term strategy towards China, a recent crisis at home painted a starkly different picture of political dysfunction. In an almost unbelievable turn of events, the United States government couldn't pay its own military. So a private billionaire just wrote a check to the Pentagon for $130 million. Amid a crippling government shutdown threatening the paychecks of 1.32 million service members, defense officials confirmed the massive gift. These payment delays put incredible financial stress on military households. Actually, research from the Consumer Financial Protection Bureau shows that even in normal times, service members file debt collection complaints at nearly twice the rate of civilian consumers. A sudden loss of a paycheck can trigger a wave of credit delinquencies, revealing just how financially vulnerable many of these families are. The donor was initially a mystery, described by Donald Trump only as a big supporter of mine and a patriot who doesn't want publicity. He was soon identified as Timothy Mellon, heir to a $15 billion family fortune and a major financial backer of Trump. The $130 million donation amounts to roughly $100 for every single service member, a stopgap measure while lawmakers failed to pass a funding deal. This kind of domestic political paralysis sends a signal to the entire world. For strategic competitors, repeated threats to US military pay are likely interpreted as a sign of declining American state capacity. It's the kind of thing that could embolden rivals to test US commitments in sensitive areas like the South China Sea. These unprecedented moves sent shockwaves through Washington. One Treasury Secretary at the time called the situation an embarrassment. But it's more than that. It's a dangerous precedent. It creates what economists call a moral hazard. The thinking goes like this. If lawmakers know that a wealthy donor can just step in to fund essential services, it reduces the pressure on them to compromise and end a shutdown. It could actually make future government shutdowns more likely and longer lasting. The real firestorm is over ethics. Pentagon rules require intense scrutiny for large gifts, especially to determine if the donor has other business before the department. One Senator, Chris Coons, framed the core conflict with a stunning warning, questioning whether our own troops are at risk of literally being bought and paid for. And he has a point. The Department of Defense has incredibly strict rules, like Army Regulation 1-100, which mandates that all gifts be reported and tracked precisely to prevent conflicts of interest. The system is designed to ensure a donation isn't a backdoor attempt to gain influence. The donation was accepted under the Pentagon's General Gift Acceptance Authority, a rule typically used for funding projects like museums, not for covering the military's base payroll. Interestingly enough, experts are starting to see this as a new form of what they call performative political spending. This is different from traditional campaign donations. Instead of just funding a political ad, a mega donor directly intervenes in a government crisis. It generates massive public goodwill for their preferred political side and creates a whole new playbook for influencing public opinion outside of regulated campaign finance. This isn't just about one shutdown or one check. It's a story about where the government's power ends and private influence begins, blurring the lines between patriotic charity and the strategic purchase of access at the highest levels of national security.
That's it for today on Gov't Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.